Beat the Market. A Scientific Stock Market System. Author Edward O. Thorp. This is a book summary. A dimly lit room. Papers, charts, and stock market tickers scattered around. A man, deep in thought, scribbles equations on a chalkboard. A cigarette smolders in an ashtray, a glass of whiskey untouched nearby. The ticking of a clock fills the silence. Imagine this. It's the 1960s. The stock market is a chaotic arena. A high-stakes casino where fortunes are made and lost in a matter of hours. Men in sharp suits swarm trading floors, eyes fixed on the ticker tape, palms slick with nervous sweat. The air buzzes with rumors, hot tips, and frantic phone calls. It's a battlefield ruled by emotions, hunches, and gut instincts. Most investors are either riding waves of luck or drowning in losses. But far from the frenzy, in quiet offices and university hallways, two men are methodically pulling back the curtain. They aren't interested in luck or hunches. For them, the market isn't a beast to be tamed. It's a code to be cracked. Armed with chalk, equations, and a relentless thirst for knowledge, Edward O. Thorp and Sheen T. Kassouf are quietly decoding the market's secrets, using math, logic, and a bit of daring. This is the story of how two professors didn't just beat the market, they rewrote the rules. A story of intellect over instinct, of science over speculation. A story detailed in the book Beat the Market. A book that reads less like a financial guide and more like a manual for pulling off the perfect heist. Before he set his sights on Wall Street, Thorp was making waves in a different kind of arena. The casinos of Las Vegas. Armed with little more than a chalkboard and a mind like a steel trap, he cracked the game of blackjack, proving that math could outsmart even the house. If he could beat the casinos, why not the stock market? A cluttered university office. Thorp and Kassouf huddle over a stack of financial statements, chalk dust clinging to their sleeves. An old radio murmurs stock prices in the background. When these two minds collided, the sparks were immediate. Where others saw randomness, they saw probabilities. Where others chased trends, they hunted for mathematical certainties. Their weapon of choice? A revolutionary system based on hedging. A technique that could transform even the riskiest investments into steady profits. Hedging was their armor, but their sword was something far simpler: warrants. These little-known financial instruments were like hidden levers in the machinery of the market, capable of tipping the scales in the right hands. Most investors dismissed them as too risky, too unpredictable. But to Thorp and Kassouf, warrants were the keys to the kingdom. But before they could crack the code, they had to survive the chaos. A chaos that wasn't just in the stock market, but in the very fabric of financial theory itself. In a world that believed the market was ruled by emotions, they had to prove that it was actually ruled by math. And so began a battle of intellect versus instinct, of chalkboards versus ticker tapes, of science versus superstition. Chapter 1: A System is Born. 1957. A young Sheen Kassouf sits in a boardroom watching the stock ticker with a frown. The room is filled with the low hum of conversations, the frantic scribbling of pencils, and the relentless clatter of a ticker tape machine. The air was heavy with cigar smoke and the scent of ambition. Around him, traders barked orders into phones, eyes gleaming with either desperation or triumph. For them, the market was a living beast, unpredictable, untamable. But Kassouf saw something different. In the chaos, he sensed a pattern, a hidden logic, almost like the faint outline of a map beneath the noise. He had entered the market with high hopes, armed with stock tips from brokers and advice from financial newsletters. But the market had little mercy for the unprepared. His portfolio bled red ink, a painful reminder that hot tips and gut feelings were traps disguised as wisdom. The deeper he went, the clearer it became. The market didn't care about intuition. But Kassouf was no ordinary investor. Failure, to him, was just another clue. Late nights found him hunched over financial statements and academic papers, eyes burning under lamplight, surrounded by towers of books and empty coffee cups. Where others sought certainty, Kassouf hunted for probabilities. He wasn't trying to predict the market, he was trying to decode it. And he knew one thing for certain: math didn't lie. Numbers didn't care about rumors or panic or the latest Wall Street fads. Numbers were pure, and if he could find the right formula, he could outsmart even the most chaotic market. While Kassouf was unraveling the secrets of Wall Street, Edward Thorp was making waves in a different kind of casino. The casinos of Las Vegas were designed to separate fools from their money with ruthless efficiency. The house always won. Or at least, that's what everyone thought, until Thorp showed up. Thorp was a mathematician with a gambler's nerve. To him, the blackjack table wasn't a game of chance, but a series of probabilities waiting to be exploited. Armed with statistics and a homemade computer, he cracked the code behind the cards, developing a strategy that turned the tables on the house. The casinos panicked. Security watched him closely. Dealers swapped decks mid-game. But it didn't matter. The math held true. The thrill of beating the house was intoxicating, but for Thorp, it was never about the money. It was about proving that luck was just another name for math we hadn't figured out yet. If he could beat the casinos, why not Wall Street? After all, the market was just another kind of casino, bigger stakes, more variables, but still ruled by probabilities. When Thorp and Kassouf's paths crossed, sparks flew. Their conversations stretched long into the night, bouncing ideas off chalkboards, pages of notes littering the floor. Kassouf's deep understanding of warrants and convertible securities met Thorp's mastery of probability theory. The synergy was electric. They saw the market not as a random beast, but as a complex system governed by predictable relationships. Their weapon of choice? Hedging, a strategy that could turn even the riskiest investments into steady profits. Their real breakthrough was in the way they analyzed warrants. Options to buy stocks at fixed prices. Most investors treated warrants like lottery tickets, chasing the thrill of outsized gains. But Thorp and Kassouf saw them as a mathematical puzzle. By plotting the relationships between warrants and their underlying stocks, they uncovered patterns that were as reliable as they were profitable. Their equations transformed the chaos of the market into a blueprint, one that didn't just survive booms and crashes but thrived in them. A blueprint that made money whether stocks were rising, falling, or staying flat. To most traders, this sounded like magic. But to Thorp and Kassouf, it was just math. Cold, beautiful, irrefutable math. And so began one of the greatest intellectual heists in Wall Street history. They weren't just beating the market, they were exposing its secrets, proving that the game wasn't about luck at all. It was about knowing the odds better than anyone else. Chapter 2: Cracking the Code with Warrants. A sunny afternoon in New Mexico. A gentle breeze rustles the leaves of a poplar tree. Edward Thorp sits beneath it, a book on stock warrants open in his lap. In the distance, desert mountains rise against a cloudless sky. Thorp flips a page, absent-mindedly pushing his glasses up the bridge of his nose. His eyes scan the words, then pause. They narrow slightly, focused. A slow smile spreads across his face. This was the turning point, the spark that would ignite a revolution in finance. Up until that moment, warrants were just another risky play in the market, a gamble that most traders approached with either reckless abandon or averted eyes. But to Thorp, warrants weren't just lottery tickets. They were keys to a deeper understanding of the market's machinery, cogs that moved with a certain logic, if you only knew how to trace them. The book in his hands was dry, filled with dense numbers and jargon. But Thorp's mind moved swiftly, stripping away the noise, piecing together the underlying logic. Warrants, options to buy stocks at fixed prices, weren't just floating on the tides of market sentiment. They were tethered to their underlying stocks by invisible strings of probability and value. If you could see those strings, you could predict their movements with uncanny accuracy. His pencil tapped the margin thoughtfully, and in that quiet New Mexico afternoon, the pieces slid into place. The idea was simple, almost elegant. If warrants moved in predictable patterns relative to their underlying stocks, why not map those patterns? Why not transform them into a visual language, something you could see at a glance? The answer took shape in a series of hurried sketches and notes, equations scrawled with increasing urgency. Thorp called it the warrant stock diagram, a simple graph with the power to reveal when warrants were overpriced or underpriced. It was like having a map in a world where everyone else was guessing directions. But this wasn't just theory. Thorp didn't trust theories until they were dragged into the light of real-world data and forced to prove themselves. So he put it to the test, poring over historical prices, feeding numbers into his calculations. The results were staggering. The graph didn't just reflect past movements, it predicted them. Time and again, it pinpointed opportunities that others missed, exposing profits hidden in plain sight. Hours blurred into days, but Thorp barely noticed. The deeper he dug, the clearer the patterns became. Some nights, he fell asleep at his desk, equations still racing through his dreams. His wife would find him there in the morning, cold coffee in one hand, pencil still clutched in the other. But Thorp was unstoppable. The numbers were revealing a language all their own, a language the market had been speaking all along, but that no one else had bothered to learn. And at the heart of it all was the diagram, lines crisscrossing over axes, each point a clue. It was like watching the stock market through a one-way mirror. You could see where the crowd was rushing, where the panic would hit, and, most importantly, where the profits lay waiting. He tested it on historical data, then on live markets, cautiously at first. The profits came in small but steady streams. Then larger ones, torrents that confirmed what he had begun to suspect. The diagram wasn't just useful, it was revolutionary. In the chaos of the trading floor, no one noticed the quiet mathematician with the leather briefcase. No one realized that the man watching calmly from the sidelines was not guessing like the rest of them. He already knew which way the market would move. The diagram was a Rosetta Stone for the stock market, a way to decode the chaos into clear signals. But for Thorp, he had cracked the first layer of the market's code. But beneath it, he suspected, lay even deeper patterns waiting to be uncovered. The warrant stock diagram would become the cornerstone of an entire system, one that didn't just beat the market but did so with the precision of a watchmaker, gears meshing smoothly, profits clicking into place with every turn. A system that would soon send shockwaves through Wall Street, leaving both skeptics and traditionalists scrambling to catch up. Thorp leaned back against the tree, eyes half closed, the edges of his graph paper fluttering in the wind. He could almost hear the tickers already, each click a step closer to the revolution he was about to unleash. And in that sunlit afternoon, the market's secrets lay open before him, plain as day. Chapter 3. Betting against the market. The power of short selling. It was June 1962, and Wall Street was bleeding. Stocks that had been the darlings of the market just months before were now in freefall. Words like crash and panic buzzed through the chaos, echoed by the screams of traders waving frantic sell orders. Blue-chip stocks that seemed untouchable lost a quarter of their value in mere weeks. Portfolios were shredded, fortunes evaporated, and the experts who had confidently predicted an endless bull run were left stammering excuses. But far from the panic, in a quiet office lined with books and chalkboards, two men watched the carnage unfold with something almost like amusement. Thorp and Sheen Kassouf, in fact, they were smiling. Because where others saw disaster, they saw opportunity. For months, they had watched the market climb higher and higher on shaky foundations, propped up by blind optimism and empty promises. And when the cracks finally spread, they were ready. They had mastered short selling, a strategy as old as the market itself but wielded with a precision no one else had managed. The idea was simple. If you knew a stock was overpriced, you could borrow shares, sell them at the inflated price, and buy them back later for a fraction of the cost. But in Thorp and Kassouf's hands, short selling wasn't just a strategy. It was an art. They didn't bet blindly. They targeted warrants, overpriced options to buy stocks at fixed prices. They charted probabilities, calculated risk margins, and hedged every move like a chess master, setting up a checkmate 5 moves in advance. While the market bucked and reeled, their strategy held steady. Profits trickled in at first, then poured. This wasn't just luck. It was a battle plan years in the making. They had tested it in simulations, refined it through historical data, and now, as Wall Street burned, it was proving itself in real time. Their system was almost invincible. During one of the worst market drops in history, they didn't just avoid losses, they made consistent profits. In fact, the deeper the market fell, the more they earned. As prices tumbled, their short positions blossomed into profits, and their hedges softened any blowback. But this wasn't just about making money. For Thorp and Kassouf, it was about proving a point, that the market wasn't a wild beast, driven solely by fear and greed. It was a machine, intricate, complex, but ultimately predictable if you knew where to look. To the rest of Wall Street, Thorp and Kassouf's success seemed almost supernatural. Luck, insider information, even sorcery. How else could they thrive when everyone else was drowning? But there was no magic, just math. Cold, unfeeling, and ruthless in its accuracy. They had taken the very tactics that the market feared: short selling, hedging, exploiting overpriced assets, and turned them into a symphony of profits. Their gains weren't flashy or reckless, they were methodical, the result of a system that left nothing to chance. Thorp's grin widened with each trade. Kassouf, ever the strategist, was already charting their next moves. They weren't just winning, they were proving a theory, a thesis that defied everything Wall Street held sacred, that the market was beatable. Kassouf and Thorp in a quiet cafe, the hum of jazz in the background, coffee cups steam between them, papers littered with equations spread across the table. Kassouf leaned back, a half smile on his face. "It's working," he said, voice low but triumphant. Thorp just chuckled, adjusting his glasses. "Of course it is," he replied. "It was always going to work. It's just math." The crash that had wiped out millions had validated every theory, every late-night calculation, every page of notes scrawled in chalk and ink. As the ticker tape continued to spew bad news and brokers clutched their heads in disbelief, 2 men watched calmly, smiles playing at the corners of their mouths, because they knew that every crash, every surge, every chaotic swing of the market was just another move in a game they had already won. Chapter 4. The basic system: high profit, low risk. A chalkboard filled with formulas. Thorp stands before a small group of investors, the room dimly lit by flickering fluorescent lights. Chalk dust hangs in the air, and the faint scent of old books and coffee lingers. The investors, a mix of seasoned brokers with loosened ties and wide-eyed newcomers, lean forward, notebooks open, pencils poised. Thorp taps the chalk rhythmically against the board, a faint smile playing at the corners of his mouth. Thorp's eyes glint with something between excitement and impatience. He knows what he's about to reveal will sound like sorcery to most of them. But to him, it's just math. Beautiful, ruthless math. "The problem with most investors," he begins, voice calm but commanding, "is they think of risk as an enemy. But what if I told you risk is just a tool, one you can balance until it cancels itself out completely?" A murmur ripples through the room. A young trader in the back crosses his arms, brow furrowed with skepticism. Thorp notices but doesn't pause. He lifts the chalk and sketches 2 lines on the board, one representing a stock's price, the other a warrant. The lines diverge and intersect, rising and falling like waves on a stormy sea. But when Thorp connects them with a series of precise sloping arrows, the chaos resolves into a pattern that means profits, no matter which way the waves crash. The brilliance of their system lay in hedging, the art of combining 2 risky investments so that the risks didn't just diminish, they cancelled each other out, leaving only the profit behind. It was like setting 2 traps and baiting both at once, knowing that no matter which way the market turned, one of them would snap shut. Imagine buying a stock while simultaneously shorting its overpriced warrant. If the stock price soared, the gains would offset any losses from the warrant. If the stock plunged, the profit from the short sale would cover the losses. It was like placing two bets on opposite sides and winning either way. Thorp's mind races faster than the calculations, spewing from the old mechanical calculator beside him. His pencil scratches against the paper, numbers spilling into tidy columns, and as the sums balance out, a thrill runs up his spine. The math holds, profits without risk. It sounds impossible, but the numbers don't lie. The system works. It's not about predicting the market, Thorp continues, eyes sweeping the room. It's about controlling it, using its own movements against itself. When you hedge correctly, it doesn't matter if the market rises or falls. You win either way. A silver-haired investor near the front, cigar gripped between two fingers, scoffs slightly. Sounds like magic, he mutters. Thorp smiles, a glint of mischief in his eyes. If it's magic, it's the kind with equations, he replies, tapping a formula on the chalkboard. The cigar smolders, but the old investor's eyes sharpen, skepticism melting into interest. Over 5 years, the system delivered the stunning 25% return annually, even during brutal market downturns. When stocks crumbled in 1962, wiping out millions, Thorp and Kassouf's portfolio barely shuddered. While brokers panicked and traders wept, their gains marched upward, steady and unrelenting. To Wall Street, Thorp was a ghost, a quiet figure who drifted through trading floors without leaving a footprint. No flashy suits, no bluster, no wild bets. Just a steady procession of trades that made money with eerie consistency. Rumors spread, he had an inside source, a hidden fortune, a deal with the devil. But the truth was far simpler. He had math. Every scenario was mapped, every risk hedged, every move balanced perfectly against its opposite. Hedging wasn't just a strategy, it was a philosophy. Where others saw chaos, they saw symmetry. Where others feared risk, they turned it into profit. And in a market ruled by uncertainty, their system was a lighthouse in the storm. Chapter 5. The Avalanche Effect. Profits on repeat. It started with a simple question. If the market falls, why not profit as it drops? For most investors, a crash was a nightmare, a tidal wave that swallowed everything in its path. But for Edward Thorp, it was the perfect storm. Because in chaos, patterns emerge. And Thorp had found one, a way not just to survive the crash but to ride it all the way down. He called it the avalanche effect. The idea was as audacious as it was simple. Reinvest the profits from short sales, compounding them trade after trade, building momentum like snow rolling downhill. With every successful short, the profits were plowed straight back into new short positions, expanding rapidly, almost exponentially. The deeper the market plunged, the faster the profits piled up. In just 1 year, $6,500 became over $84,000. It was like watching a dam burst, profits rushing in faster than he could count. But this wasn't just luck. Luck was random, fickle, a coin tossed in the dark. This was precise, calculated. It was math. The avalanche effect wasn't about timing the market or chasing trends. It was about turning the market's own momentum against itself. When stocks fell, they triggered margin calls, which forced more sales, which drove prices even lower. A downward spiral that Thorp had mapped out in painstaking detail. All he had to do was pull the right levers. To most traders, the idea of shorting stocks, betting on prices to fall, was madness. After all, stocks always recovered eventually. But Thorp wasn't interested in eventually. He was interested in right now, in the profits that could be extracted in days, even hours, from stocks caught in a death spiral. The New York Stock Exchange, chaos. Traders wave slips of paper, faces flushed, eyes wide. Screens flash red. In a quiet corner, Thorp watches calmly, a faint smile playing at the edges of his mouth. To the rest of Wall Street, it was like watching a ghost. But the truth was simpler. Thorp had cracked the code. By hedging every trade, he'd made the risks vanish, leaving only the profits behind. As stocks plummeted, he was already a step ahead, reinvesting gains before the market could catch its breath. Every dollar of profit became a spearhead for the next short sale, carving a path through the chaos. The avalanche effect wasn't just a strategy, it was a revolution. Thorp clicks to the next slide, a line graph showing the staggering rise of his portfolio. But Thorp isn't here to gloat. He's here to prove a point. The market isn't unpredictable. It's a system, and every system can be broken. It's not about timing the market, he says, voice calm and sure. It's about knowing how the pieces move and positioning yourself to profit no matter which way they fall. A young trader near the back blurts out, half in awe, half in disbelief, "So, what's the risk?" Thorp smiles, almost kindly. "There isn't one," he replies, "not if you do it right." That was the true brilliance of the avalanche effect. It wasn't just about making money, it was about eliminating risk entirely. By hedging every trade, by balancing every bet, Thorp had found a way to profit no matter which way the market turned. Kassouf smirks, shaking his head slowly, almost disbelieving. "It shouldn't be this easy," he mutters, eyes flicking over the numbers again and again. Thorp chuckles, leaning back in his chair. "It's not," he says. "We're just the first ones to see it." The rest of Wall Street was still stumbling through the dark, chasing tips, following trends, praying for rebounds. Chapter 6. Sharing the Secret. Thorp and Kassouf at a conference. A grand hall with chandeliers casting warm light, rows of investors in suits, eyes narrowed with suspicion. The air buzzes with murmurs and the occasional scoff. On stage, Thorp adjusts his glasses, calm and composed, a faint smile curving his lips. Beside him, Kassouf leans back, arms crossed, watching the crowd with something between amusement and challenge. To most of the audience, this all seemed impossible. The idea that anyone could beat the market, not just once but consistently, was heresy. They were Wall Street veterans, men who'd built careers on the assumption that the market was a chaotic beast, untamable and unpredictable. To them, Thorp and Kassouf's claims were like a magician stepping on stage and promising to make the Statue of Liberty disappear. A silver-haired broker in the front row cleared his throat loudly. "If this works so well," he called out, "why tell us about it? Why share the secret?" Thorp chuckled softly. "So why share this gold mine with the world?" Thorp repeated, "Simple. Because knowledge should be open. Because the market is big enough for more winners. And," he added, almost as an afterthought, "because it's more fun this way." Laughter rippled uneasily through the room. A few investors leaned back, crossing their arms tighter. Others scribbled furiously in notebooks, heads down, eyes darting between Thorp and the chalkboard behind him, covered in equations and graphs. For many, the book was a revelation. For others, a threat. Rumors spread that hedge funds were buying out entire print runs to keep the knowledge under wraps, that Wall Street's elite was scrambling to discredit the methods before they caught on. But the genie was already out of the bottle. Today, their ideas are woven into the very fabric of quantitative trading. Hedge funds and investment banks use strategies born directly from Thorp's formulas, spinning profits out of volatility and chaos with machine precision. Even the concept of hedging, now a cornerstone of modern finance, owes much to their work. Every time an algorithm places a trade to balance risk, every time a hedge fund shorts an overpriced asset, it's echoing the techniques that Thorp and Kassouf pioneered. Thorp's legacy isn't just in the billions earned or the textbooks written. It's in every trader who looks at a plunging market and sees not panic, but possibility. Every student who picks up a pen and starts scribbling equations, eyes bright with the same fire that drove Thorp and Kassouf. So, next time you see the stock market's wild swings, remember, behind every chart and every trade, there's a code waiting to be cracked. And it all started with a professor under a tree in New Mexico, a chalkboard full of equations, and a question no one else had dared to ask. And if you like this story, don't forget to like, subscribe, and hit that bell for more mind-blowing tales from the world of finance. Thanks for watching, and stay curious.